All right. Good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to our bi-monthly research call. We hold these on the first and third Wednesday of every month, and we're delighted you could join us today. It's been a very exciting couple of weeks in the oil market and energy markets writ large, so I think we've got a lot to discuss here today. So to kick things off, I think we're going to start with commodity macro, and for that we're going to go to Salih Yilmaz. Salih, where are we at in the oil market right now? How tight is the supply-demand balance, and what type of geopolitical risk premium do you think we're seeing in the oil market today?
Sure. Thanks, Rob. So let's perhaps start with the geopolitical risk, because I think what we're seeing in the market very recently is very much being driven by the events and the headlines that we're getting from the Russia-Ukraine tensions. And earlier in the week, we saw Brent shoot above $96 a barrel before falling back down to below $93 a barrel. And currently, I'm looking at my screen now, it's around $95 a barrel. So we've definitely seen volatility go up, given there's so much uncertainty on what's going on in Russia and Ukraine. And as we've talked about on this call before, there's clearly this geopolitical risk premium on prices that is quite difficult to quantify, but perhaps up to $5 a barrel, maybe even more, that we're seeing in the market. But again, I don't think we should be distracted by what's going on in the very near term and perhaps with these geopolitical events, but rather focus on the fundamentals that we've kind of highlighted before remain very strong and very solid for the whole year. I mean, it is a very tight market. When we look at the oil curve, it is in a steep backwardation, which is a very bullish sign. When we look at demand indicators, they're all pointing to continued very strong recovery. I mean, we have U.S. oil demand already at pre-pandemic level. We have inventories that are below 10-year average now. We've been talking about 5-year average, and when we will reach that point and perhaps go below that, now global inventories are below the 10-year average. We have, on the supply side, increasing concerns that OPEC will continue to fall short on their targets. So we have the supply shortfall, supply really struggling to keep up with very strong and rising demand. At the same time, we have had that spare capacity that we've been counting on that looks like may have been overestimated. I mean, the official numbers, according to Bloomberg data, is above 5 million barrels per day right now, but our scenario analysis suggests that number may be more like 4 million barrels per day, perhaps even a bit lower than that. So we have that spare capacity that may have been overestimated and is falling and will continue to fall through this year. And as that falls, I think that will make markets more and more anxious, perhaps supporting prices further. So I think the fundamental setup, as we've said many times before, is what's important, because that's not just the news for the next couple of weeks, but it is kind of what will be driving the market for the whole year. And we continue to see a very strong market. We continue to see the risk skewed still to the upside, even at Brent at around $95 a barrel. So we think, and we had a note about this we published earlier today, we think this $100 a barrel oil that we've been talking about, we've been hearing about a lot, and this perhaps super cycle, I think it's already here. But obviously, we think this is going to be a relatively short-lived one, because I think, and I mean, perhaps later on this call we can talk about that. I don't want to take too much time right now, but I think the fundamental setup for this year for oil prices remains very, very strong.
Okay, Salih, very tight near-term fundamental outlook that you just told us about. I want to stretch your mind and sort of get input from the group here to look a little bit longer term. Just this morning, there is a conference occurring that's being put on by the International Energy Forum. A lot of great speakers, the IEA's in attendance, OPEC's in attendance, and they showed a really interesting chart put together by Resources for the Future that showed the broad spectrum of how oil demand could unfold over the next 30 years. And one of the really cool takeaways from their chart is that in 2050, the spectrum of what different people say oil demand could be is greater than current global oil demand. So there's a lot of uncertainty on where we head over the long term. How do you read the tea leaves there, and how do you connect that to the current market? And so we'll start with you, Salih, but I want to bring others in on this as well.
That is a fascinating chart on how the range of oil demand projections for 2050 is about 112 million barrels per day. We see currently we are at a demand number of around 100 million barrels per day. And obviously, as you said, when we say uncertainty about the transition and about what will happen to demand, we really mean it. And I think, again, in the very near term, as I said, there was also a lot of uncertainty about how we come out of the pandemic. I mean, do we really lose, like the barrels that we lost on the demand side? How much of that is structural? How much of it will come back? And what we're seeing in the very near term is that demand is recovering faster and more strongly than we had imagined it. But I should say, the headwinds that we've been talking about demand that are longer term are still there. I mean, we know EV adoption and the accelerating EV adoption is something that we talked about, and we know it will, the new car sales numbers are impressive, but compared to the actual fleet, car fleet globally, which is about 1 billion cars, it will take a while for that to actually start eating away from demand. Fuel efficiency is another one that is supposed to be taking away from oil demand in the long term, but something we talked about on here before. We've been promised a lot of fuel efficiencies in the last 5 to 10 years, but we didn't quite get that. I mean, in the conference earlier today, I was listening to it by the IEF. I've been talking about how more and more people have been buying SUVs, which almost kind of offset all the fuel efficiency. But again, I think we shouldn't be discouraged by what's happened in the last 5 years. I think this remains a long-term headwind for oil demand. And I should also say, look, we are about to hit $100 of oil price. We're not quite yet seeing demand destruction. I mean, we continue to see refining margins extremely strong globally. So we may not be at demand destruction zone just yet, but obviously, the longer these high prices stay or higher they go, I think we will see a more incentive for consumer behavior to change. So we would see more people kind of not choosing SUVs, but perhaps looking for EVs or more fuel efficient cars, which will perhaps not going to make a huge difference in the next few years. But when we look at 2030, 2035, we will see kind of demand getting trimmed by those consumer behaviors as well.
Okay, so Will, I want to get your read when you look into the individual companies. When I look at this chart, IEA's net zero scenario, I think, is one of the most bearish demand scenarios out there. But when I look, I see Equinor, BP, others. They have some worlds that they can envision that are quite pessimistic for demand. And how do you reconcile that demand view with CapEx? I mean, how are they approaching this uncertain demand when you're making, multi-year, multi-billion-dollar type investments?
Yeah, thanks, Rob. So for the European majors, they're pursuing a relatively similar strategy in that longer term, they're sort of feathering their weight within upstream to slightly lower year over year. We're not talking about a massive cliff edge drop here in CapEx, but we're looking at, current levels of somewhere around half or maybe 2/3 of spending to slowly ease down throughout this decade. To maybe 40% of total capex or 1/3 of capex. So this way, these companies can still maintain some of that oil price exposure, and for obvious reasons, we're seeing that pay off very well right now. But it also provides them a bit of runway in order to fully deploy their energy transition strategies. So many of these companies are also ramping up their transition spending in renewable power capacity, in biofuels, in battery, in electric vehicle charging, and keep in mind that these are massive companies, and it takes at least a decade for them to sort of turn around strategically, and so this is what we expect. This steady, gradual pivoting of the business from oil to gas to electrons over decades, not quarters.
Well, I love that framing, oil to gas to electrons. One of the other charts that we saw this morning from our friends at IEF and Resources for the Future is same chart, but global gas demand. And I think many in the industry have thought of gas demand as being an upward sloping curve to the right. But when you look across all the scenarios, there are some quite bearish gas demand outlooks out there as well. And I think particularly as we're seeing the gas crisis in Europe right now, we're contemplating the role of Ukraine and Russia and their influence over the European gas market. Is gas still this sort of preeminent low-carbon transition strategy for most of the oil majors, or energy majors as they want to be called now?
So yes, and I think similar to what you were talking about with Sally, with these long-term views out to 2050, I may perhaps controversially think that they're a bit of an exercise in futility. There's not many, if any, investors out there that are working on a 30-year investment horizon in these commodities. So I would suggest that what investors look at is what we do know. What do we know right now, and what do we have some view of in the years ahead? And in the few years ahead, in the next 5, maybe 10, global gas demand looks strong. We have underbuilt global LNG capacity. There is a big push to move from coal to gas in power generation for obvious emissions and pollution reasons. On top of that, we are seeing a massive electrification of the global energy system. A lot of this is going to be powered by gas. This is not to take away from the rapid growth of renewable power capacity, which is occurring. And I do believe that it does pose a longer term threat to global gas demand. But I think in the next 5-10 years, gas will remain and grow as a share of primary global energy consumption. And we're seeing that in LNG, and we're also seeing some of these market spasms, like you mentioned in Europe, which are struggling with the still gradually, globalizing commodity of gas, but still struggling with these regional supply issues and demand, struggles to get the supply in.
Very interesting. So let's bring on Patricio Alvarez, who looks after our gas narrative here in Europe, and also looks after utilities. So, Patricio, I want you to kind of just weigh in on kind of your view on the European gas market, and I want to ask a question for you about EDF. So, in general, EDF company, everybody knows them. They've got a big nuclear portfolio. In my mind, and on back of the envelope, high gas price is great if you have a nuclear portfolio. I think they've struggled a bit more. So both tell us what's going on with EDF and give us your read on where the gas market's headed over the next 3 to 6 months.
Sure. So first on EDF, as you well say, Rob, having a large base of baseload power generation, such as hydroelectricity or nuclear for that matter, is a great environment when you have exposure to these surge in wholesale power prices. So this is why well, we've seen EDF hit over the past few weeks because this comes on the back of the French government's announcement that it will cap power price increases for households at 4% this year. So that really took the breath out of EDF with consensus revisions for 2022 EBITDA ranging from anywhere from 50 to 60%. And on top of that, there's the other factor that seems to be a bit more structural, which is the aging of its nuclear fleet, which has seen extended outages from 2021, which were regular 10-year maintenance outages, extend into this year. And we've just recently seen the company extend these outages into 2023 and also cut their forecast for 2023 by about 40 terawatts. And while we don't expect this to have the same magnitude of impact on EBITDA, although it's excluding, we assume that by 2023 the French government is going to lift these temporary measures. We don't expect the same type of impact on 2023 EBITDA, but nonetheless, it's significant if you consider that power prices are close to 200 euros and you're being forced to sell at a regulated price of about 50 euros per megawatt. So this will fluctuate. This just brings more and more attention to EDF's next earnings call on Friday, where we expect to see a lot of focus on what the measures are, on what the financial impact is for 2022, 2023, and perhaps some update on what the French government has been saying about they'll back EDF, they'll support its finances, they're revamping the nuclear program in France. With President Macron saying that up to 14 new reactors will be built over the next decade. Sorry, not from the next decade, from 2030 onwards. But they'll start investing now, which all these things are a bit contradictory, just seeing what the state of EDF is at the moment. So very interested on that earnings call. As into moving on to the gas market in Europe. So we've seen gas prices ease over the first 6 weeks or so of this year, and that's mainly because of two external factors that we sort of accounted for in our analysis. One of them is we've had a milder weather. We've had a relatively mild winter, and the other one is an sustained influx of LNG cargoes from the U.S. And this is both. Well, this is due to an easing demand in Asia. So they stopped diverting cargoes there, but we don't see this as a sustainable trajectory for the rest of the year. The other thing that we have to look at as well is the tensions between Russia and Ukraine. We've seen prices ease on Tuesday by about 15% versus prices on Monday, and that's mainly due to this mixed messages of easing tensions, of potentially of Russia actually just these were drills and now they're withdrawing. Although this hasn't been confirmed, it seems that it had an effect, and we're now at about 70 euros per megawatt, which is a lot less than the 200 euros per megawatt, 150 euros per megawatt we were in December. But nonetheless, it's still 4 times as much as the price was in 2021 for this time of the year. Another key factor that we're keeping a really close eye on is storage levels. So now, because of these two, LNG and easy milder weather, we've seen storage levels track back towards the low bound of the norm for the past 5 years. So this is good news because it means that I'm agreeing with Ursula von der Leyen on this, who just commented on this. We're on the safe side of gas demand now in Europe. We have security of supply for the rest of the winter, so that means for the next 6 weeks. But now we're taking a look at what might happen for the next 6 months. So looking at what companies do to refill their storages, which we see as very hard to attain now with this level of costs. So there's been a speculation or no talks of actually regulating the storage levels in certain countries such as Germany, actually instating rules so that Uniper, RWE, and Gazprom are sort of mandated to have minimum levels of storage, because right now there won't be any incentive for most utilities to refill their storages at these high levels, pricing levels. So that's the outlook.
Thank you, Patricio. Very interesting. I note that you talked about the idea that while we may have seen some recent easing in the gas price, it's still up about 4x versus the recent run-up. So if EDF is not going to be a company that can sort of take advantage of this tremendous run in commodities that we've seen, I think there are some names that are quite levered to the European gas market. And so, Will, I want to come back to you, toot your horn a little bit. You've got a focus idea on Equinor and how they're exposed to the gas rally. Why don't you break that down for us real quickly and tell us how Equinor has the potential to perform under this incredible gas price rally we've seen here in Europe?
Yeah, thanks, Rob. So after Gazprom, Equinor is Europe's second largest gas supplier. This is largely due to some major fields that they have on the continental shelf. It's nearly all pipe supply into Europe. They have one very small LNG facility in northern Norway. But just given the scale of their gas production that they serve Europe with, and they have very high spot gas exposure as well, Equinor really represents, we think, one of the best options for investors to play as both an inflation hedge and a geopolitical risk hedge as well. They are uniquely positioned, simply given their gas production into Europe, their spot gas exposure, and also their operational strength. The company recorded a record high gas production levels in the fourth quarter. We expect these levels to be sustained or grow even further. This is because the company is optimizing some of their flexible gas fields. So they're producing essentially as much as they can to capture as much value from these elevated price benchmarks that we're seeing. And I think obviously against the backdrop of geopolitical risk in Eastern Europe with Russia threatening an attack on Ukraine, if that were to occur, we think Equinor would be one of the best placed companies to see a benefit from obviously elevated gas pricing, but also oil pricing, as well as we would expect these commodities to bounce on that event.
Will, while we've got you, why don't you give us a quick rundown of what we've heard broadly from the European energy majors as they've reported, in addition to benefiting from the rally in both gas and oil prices. I note that you hinted at some shifting strategies. And so give us a sense on kind of what are they doing with all the cash that they're generating right now?
Yeah, so unsurprisingly, the fourth quarter was a very strong quarter for the entire peer group. We saw record earnings and cash flow for several companies, and this is on the back of a much more supportive commodity price backdrop, obviously. But which it might be slightly counterintuitive, but most of these strategies are accelerating away from the business units that are delivering these massive earnings and cash flow numbers. We've seen an increased commitment from nearly all these management teams to increase or upgrade the share of their capex that they will be dedicating to their energy transition businesses by mid-decade or by 2030. And I think this really shows this commitment to the energy transition and particularly their emissions profiles. We're also seeing a lot of this cash being deployed into buybacks. And it's clear that the management teams are viewing buybacks as the favored shareholder distribution mechanism over dividends. I think the flexibility of them and the short-term commitment, these buyback tranches are achieved over a quarter or a half year. And so it allows these management teams to quickly adjust and be much more flexible with this distribution policy. We also saw some extraordinary dividends announced from Equinor as well, giving back some of that gas value to their investors. And we're also seeing some incremental and minor dividend upgrades, as some of these companies continue their slow and gradual payout recovery from pre-pandemic levels. We're still seeing BP and Shell's dividend at roughly half of where it was before the pandemic. Equinor is nearly recovered, and Total and Eni have both either recovered or risen above their pre-pandemic levels for dividends. And so we continue to see this excess level of cash being generated, at least in the near term, likely throughout the first half of this year. And this surplus cash is being will continue to be deployed into buybacks, slightly higher dividends, and of course, continuing M&A, particularly in the energy transition, renewable power space.
Will, I want to get your reaction to some very compelling slides, I thought, from a number of the energy majors that really outline their strategies. So Total Energies, I think, is allocating about $3 billion in capex this year to electricity and renewables. They've got 10 gigawatts of installed renewable capacity. I think they're hoping to get that up to 16 gigawatts just this year, with a longer-term goal of 35 gigawatts in 2025. These are very rapid increases in renewable power capacity. What's the narrative that they're communicating on that? Are these lower return investments? Are they figuring out how to do this in a relatively profitable, high payback kind of way?
So all of these companies have been pretty transparent about their anticipated project return rates for renewables, and they all range around 8 to 10% on a levered basis, give or take a percent or two. And these are historically lower margin businesses than oil and gas, and I don't think anyone is trying to hide that. You can compare a typical conventional oil project to maybe 15 to 20% project IRR. So yes, they are lower return. However, one benefit that has been flagged is that they are much less volatile from a return standpoint over a longer time horizon. So we have flagged that expansion into these historically lower margin businesses is a potential returns headwind over the long run. But as I mentioned before, this is a gradual change in portfolio mix and product mix for these companies. While the growth in installed gigawatts is really quite rapid, keep in mind that it still comprises a small minority of these companies' earnings profiles at the moment.
Patricio, I want you to weigh in just quickly, because I know we're bumping up on time here, but Will just talked about the idea of lower return but less volatile. Is that how you read investment in clean, renewable power? And what do your companies make of the likes of Total Energies, BP, et cetera, coming into what has been traditionally their turf?
Sure. So on stability of returns, I think that's hard to argue, because most of the renewable projects are set under a long-term fixed contract for fixed pricing, so contracts for difference or PPAs directly with corporate consumers. So they are seen as a safer, more stable stream of cash flow for sure. The return profile, I'd say, is lower, as Will mentioned. But you have to consider that the leaders in the generation space can reach up to 15% of return on capital employed. But then you have anywhere ranging from 8 to 12, I'd say, is the average. And the second question, as into what they think, I think for now, you can say that the pie looks big enough. If you look at the very ambitious growth targets for renewables here in Europe and the U.S., most developed economies, and especially China as well, there's definitely room for both. I'd say both sectors to thrive and expand. I was surprised to hear that Total was aiming to expand to 35 gigawatts by 2025. That's probably higher than Ørsted, which is the the most famous renewable focused utility in Europe, which aims to have 50 gigawatts by 2030. But still, it's quite, they're coming for us, I think. So yeah, we'll be on the lookout for that.
We're going to have a arm wrestling contest. Who's going to win the energy transition? Is it going to be big oil? Is it going to be utilities? Maybe some of both. Salih, with that in mind, I want to come back to you. Last thought on energy transition, renewables. You cover Saudi Aramco, Rosneft, and some of the other not exactly European names. So how are they thinking about the energy transition? Are they doing any of this renewable stuff yet? Where's their mind and strategy on this kind of topic?
Sure. Thanks, Rob. I mean, not quite the way we're seeing big oil majors kind of approach the energy transition. I mean, when we look at both Aramco and Rosneft, and I should mention, when we look at just this quarter, and Rosneft has reported, Aramco hasn't reported yet, but when we look at 4Q and we look at this year, they are in a good position because it's very strong commodity pricing, but they're also in a unique position where they're increasing their output because their output has been artificially low because of the OPEC Plus accord, where we are seeing tapering of these output cuts. So we are seeing both Aramco and Rosneft gradually increase their output and will continue to do so through this year. So they're in a very good position. And when we look at longer term, we are seeing them kind of mention energy transition, I guess, more than before, but still less often than the international oil majors. But when we look at their strategy, we know Aramco is ready to invest more into their upstream business to increase their oil production capacity from about 12 million barrels per day by 1 million barrels per day to 13, because I think they see this reduction in investment into the legacy oil and gas business globally. So I think they see this opportunity for them to come in and grab that market share, and I think they will do that. I should mention the UAE, ADNOC is doing something very similar, and Rosneft as well. I mean, we know that they have a huge oil project called Vostok Oil Project, which is a multi-billion-dollar project where which shows their longer-term kind of strategy to double down on oil and gas production. So, I think I wouldn't be surprised if we kind of hear them and perhaps even see them make some investment, make some M&A into clean energies. But for now, we're not quite seeing them talk about their capex and kind of portion of that going to lower carbon energies as much as the international oil majors, especially the European names that Will covers and often talks about on this call.
Thank you so much, Salih. That's going to have to be the last word for today. As you can see, most of us are in the office today. If you happen to be passing through central London, reach out. We're happy to pop down and say hello to you. Obviously, everything that we talked about, you can find on BI Go on the Bloomberg terminal. Read our research. Ask us questions. We hope we can help bring all of this kind of stuff to life for you. So again, thank you for your time. I hope you have a wonderful week, and we hope to hear from you soon. Take care.